back to Community Career Podcast Personal Finance Edition. This is Rashmi and I'm joined by my co-host Olivia.
Today we're going to talk about the Silicon Valley Bank failure. I'm sure we've heard about it, but you may be wondering why it happened, and that's what we'll be uncovering today.
Silicon Valley Bank is a subsidiary of the SVB Financial Group. It was the 16th largest bank in the United States, and the bank had assets of about $209 billion in December of 2022.
This bank provided business banking services for companies, but it was well known for helping startups and venture-backed firms. In their website, it said that 44% of venture-backed technology and healthcare IPOs, which is when the shares of a company go public, in 2022 were actually clients of the Silicon Valley Bank.
So this bank was definitely a big deal. But before we continue, let's talk about how Silicon Valley Bank even started. During a poker game, two men, Bill Biggerstaff and Robert Medeiros, came up with the idea for Silicon Valley Bank. And in 1983, these two guys, along with the bank's CEO, Roger Smith, opened the first branch in San Jose, California.
Between 2019 and 2022, Silicon Valley Bank had a massive growth due to the boom in its sector and region. At that time, startups were a popular method for investors to invest in, which is a lot of the money which was deposited in SVB. This tripled the deposits from $62 billion at the end of 2019 to $189 billion at the end of 2022.
That was only the span of 2 years, which is crazy. Well, this means that the bank had a significant amount of deposits and assets. Two popular methods that banks use to make money are from loans and two, investing into securities. So the bank invested a lot of the money into treasury bonds and other long-term debts, which tend to have somewhat low returns for low risk.
But this was also during the pandemic when the Federal Reserve increased interest rates in response to the high inflation at the time. This is when the assets in which Silicon Valley Bank invested became much riskier than before.
So the reason why these were risky was because when they increased interest rates, it allowed investors to buy bonds at higher interest rates, which means higher returns on their investments. This is exactly what any investor would want, earning as much as they can. Now, the bonds that Silicon Valley bought don't hold as much as value as they did when they bought it, making it risky.
And as if that wasn't enough, some Silicon Valley Bank customers hit financial troubles and began to withdraw funds from their accounts.
In order to accommodate these withdrawals, Silicon Bank decided to sell some of its investments, which came at a loss due to the low interest rates that it had compared to the rest of the market. SVB ended up losing $1.8 billion and marked the beginning of the end for the bank.
However, there are claims that Silicon Valley Bank's downfall happened way before this and rooted into the early rollback of the Dodd-Frank Act, which was a key banking regulation enacted post the 2008 financial crisis. The 2018 Economic Growth, Regulatory Relief, and Consumer Protection Act, signed by President Trump, raised the asset threshold for additional oversight from $50 billion to $250 billion.
So now, despite being the 16th largest bank, Silicon Valley Bank fell below this threshold, escaping heightened regulatory scrutiny it might have faced if the original threshold had been maintained.
What's really interesting about this is that, although it actually took several years for the bank to collapse, from the outsider's perspective, it seemed like it happened over the span of a couple of days.
According to Investopedia, on March 8th, Silicon Valley announced its $1.8 billion loss on its bond portfolio, plus plans to sell both common and preferred stock to raise $2.25 billion.
However, this resulted in Moody's bond rating agency to downgrade Silicon Valley Bank's long-term local currency bank deposit and issuer ratings.
And on March 9th, the stock for Silicon Valley Bank's holding company, SVB Financial Group, crashed at the market opening. This resulted in more SVB customers withdrawing their money for a total attempted withdrawal of $42 billion.
And on March 10th, trading was stopped for the Silicon Valley Bank Financial Group stock, and federal regulators said that they would take it over.
And on March 12th, federal regulators announced emergency measures in response to the Silicon Valley Bank failure, allowing customers to recover all funds, including those that were uninsured, which means if it's above the $250,000 mark, which most banks usually say, even after that point in time, they're able to insure that as well.
And then on March 17th, SVB Financial Group finally filed for bankruptcy, and on the 26th, First Citizens Bank bought all of Silicon Valley Bank except for $90 billion of securities and other assets that remained in FDIC reviewership.
This was definitely an insightful episode for me. I never knew Silicon Valley Bank had this much in the background, and I hope it was just as much for you. That's all for today's episode of the Community Corner Podcast, Personal Finance Edition. Thanks for tuning in. This is Rashmi and Olivia. Cash it off.